Adcock Ingram has posted a 10% dip in first half headline earnings per share to just less than 200 cents. Samantha Louw caught up with the company's CEO, Jonathan Louw, for more on those numbers.
We've seen interesting trends. So, for example, in FMCG, the typical big retailers, we've seen most healthcare categories in absolute volume decline. So they're about 7 or 8% down versus the previous year. So people are buying less analgesics, less vitamins and tonics, less comfort medicines. So that's FMCG. In the pharmacy side of the business, however, there's still been quite good volume growth. And generally, we find that consumers are quite reluctant to experiment. So we've seen most of our core brands have actually done quite well. So the likes of Panado, Citrusoda, BioPlus, Vitathine, these brands have done pretty well.
On the prescription side of the business, you had no single exit price increase during the period. It's a highly regulated part of your business, and revenue falling back here by 8%, profits under pressure. How do you reverse the negative trend in sales and profits in this side of the business?
Prescription side of the business has been very challenging, as you've picked up. So we've had challenges in our factories with the upgrades. So sometimes we've had a few stockouts. Hopefully that'll now be a thing of the past. The discontinued businesses, as I mentioned, being the DPP issue, the loss of the antiretroviral tender in the previous year, and then of course some multinationals taking back their own businesses. We've offset that by these new partnerships. So increasingly, as big multinational pharmaceutical companies find that their core business comes under pressure from new generics entering the market, as they face the same utility cost increases that we have in our business, they look to different models, different partnerships, different ways of collaborating to reduce their cost base and also increase their share of voice in the market. So Adcock is well positioned as a company that's a local manufacturer, that's empowered, and that has a large rep force out there with a strong presence in pharmacy and at doctors. We've done the Campbell-Bellman study again, and we showed that we're still #1 in pharmacy and right up there with GPs as well. So we're able to give them a greater presence with their particular products. So more collaborations is certainly something I think that will continue to offset the issues that we've had in this previous year.
On the hospital side of the business, of course, still also a key part of the overall Adcock model. Turnover up slightly there, 4% increase. Volumes also slightly up on the period, but overall profits flat for the period. How much focus are you putting into the hospital side of the division? What type of products and type of services are you focusing on right now?
The challenge with the hospital business has been the factory upgrade. So we were very happy to announce that factory upgrade is now complete. We opened it on the 3rd of May. You know, I think where previously in the last year we've had to import a lot of the product, and you know, importing big bags of normal saline from the Americas is not particularly sensible and comes at a high cost. And in fact, almost all of the product that we bought in, we made no margin on at all. But we managed at least to keep up continuity of supply with our big customers. So the plan now is that we don't have to import anymore from our partner in Baxter. We're able to produce entirely in our new facility, which has been upgraded to obviously a far greater level of regulatory compliance. So we're also now able to explore export markets beyond South Africa. So I think you should see a widening of the margin in the next 6 months, and hopefully we'll find more efficiencies in that particular plant as well.
That brings me to the next question, because overall margins slipping back from 49.2% to 46.7%. You've got the weaker rand, which is still going to play into the earnings going forward. The rand is weakened further this year. That is also a factor. You've still got cost push pressures that you have to contend with. So to what extent are you going to be able to recover that margin in, say, the second half?
Yeah, it's difficult to say. The first thing that will offset the margin a little bit is we do have a 2.14% price increase that came through in April. So that should hopefully be 1 to 2 basis points will be realized in terms of the margin. So the price increase will help. Certainly we hope that there's better trading conditions and there's a stronger or better winter than we've had so far, because most of our business is cold and flu dependent. So obviously the more illnesses out there, the better a business like Adcock does. And then of course utility costs. So price of petrol hopefully will come down a little bit. We're a big distributor too, so that should affect our margins. And then as we add more multinational partnerships and add more volume, we get greater efficiencies both in our factories and in our DCs. So maybe there's a bit of margin widening in the second half of the year. Difficult to say.
You've clearly stated that you're targeting acquisitive growth. What size and type of acquisition are you on the lookout for?
It's not really a size that we look for. So we've been, in terms of acquisitive activity, focusing on a few core areas. The first is Africa. So we've said that West Africa we'd like to have a greater presence in. So naturally, you can't ignore Nigeria with its 140 odd million people. Moving up French West Africa as well is very interesting for us, even into North Africa. In East Africa, we need to consolidate our position, so we're also looking for acquisitions there. Haven't been able to find a reasonable sized one as yet. And in Africa, a large business would be about 150 to 200 million rands. So not particularly big businesses there. India, we've also been looking there for some time. And there you can get into businesses that can be north of R1 billion quite comfortably. So it's chicken and egg, depends which comes first.